In 2008, in a study, you could buy a decent home in the United States for about $300,000. 2 years later, that same house cost $450,000. Everyone called it a housing boom. But it wasn't appreciation, it was inflation, engineered at the highest level. Between March 2020 and March 2022, the Federal Reserve created roughly $4.5 trillion out of thin air. They said it was to stabilize markets. What it really did was destabilize purchasing power. That tidal wave of new money didn't flow into your bank account, it flowed into Wall Street's. While you worked through lockdowns and rising grocery bills, asset owners watched their portfolios double. The result? Your savings lost 30% of their real value without a single vote being cast. Inflation became the quietest form of theft in modern history, a transfer of wealth from those who earn to those who already own. And yet, very few people understand how it happened. They hear phrases like quantitative easing, monetary stimulus, and liquidity injection, technical camouflage that hides a simple truth. New dollars were created, given to banks, and used to inflate the price of everything you need to survive. This film breaks down the exact mechanism, who executed it, who profited, and why ordinary Americans are now permanently poorer. Because to see the theft, you have to follow the money, starting at the source. When the pandemic hit in March 2020, markets collapsed. The S&P 500 fell more than 35% in 1 month. Businesses closed, unemployment spiked to 14%, and the Federal Reserve faced a choice: allow a natural correction or rewrite the rules again. They chose the printer. On March 15, 2020, the Fed announced unlimited quantitative easing. The word unlimited changed history. It meant the central bank would buy as many U.S. Treasuries and mortgage-backed securities as needed to prevent prices from falling. Here's what that really means. The Fed doesn't need printing presses anymore. It creates dollars electronically inside the banking system. It opens a digital ledger, types new numbers, and credits commercial banks with fresh reserves. In return, those banks hand over government bonds and other securities. Suddenly, the banking sector is flooded with new money to lend or invest, and the Fed's balance sheet, its list of assets, swells. Before the 2008 financial crisis, that balance sheet was about $800 billion. After multiple rounds of money creation in the following decade, it reached $4 trillion by early 2020. Then came COVID, and within just 24 months, the Fed added another $4.5 trillion, doubling its size to nearly $9 trillion, the fastest monetary expansion in American history. To put it simply, the Fed printed more money in 2 years than it had in the previous 100. But here's the key: you never saw that money. There were no $4.5 trillion worth of checks mailed to citizens. Instead, the cash went straight to banks, hedge funds, and institutional investors, the financial arteries of the system. These institutions suddenly had mountains of liquidity and nowhere safe to park it except in assets. They poured it into stocks, corporate bonds, and real estate, igniting one of the fastest asset price booms in history. By August 2020, the same stock market that had crashed in March was setting record highs again. In theory, this process was meant to support employment and keep credit flowing. In reality, it rewarded anyone who already owned financial assets and punished everyone who didn't. The Fed claimed to be stabilizing the economy. What it stabilized was the wealth of the top 10%. That's the heart of quantitative easing, not an abstract policy, but a conveyor belt moving trillions from the future purchasing power of ordinary people into the present portfolios of the elite. Once the $4.5 trillion was created, it didn't flow into Main Street. It stopped at Wall Street's gates. The first recipients of new money were the big banks. They sold treasury bonds and mortgage securities to the Federal Reserve and suddenly found themselves sitting on unprecedented cash reserves. But there was a problem. The real economy was frozen. Small businesses were closed, consumers were locked down, and lending looked risky. So banks didn't push that liquidity into new business loans or credit for workers. Instead, they invested aggressively. They bought stocks, corporate bonds, real estate-backed assets, and even funneled capital into private equity funds. With the cost of borrowing at nearly 0%, money became a weapon. For wealthy clients, this was a once-in-a-lifetime opportunity. If you owned $10 million in stocks, you could walk into your bank and take out a low-interest margin loan, borrowing $3 to $5 million at roughly 1% interest, secured by your portfolio. That borrowed money could buy more assets, houses, more stocks, more anything. The system essentially let the wealthy print their own profits. As long as asset prices rose faster than 1%, they were compounding wealth with borrowed money. Meanwhile, the average worker couldn't access that game. If you had $20,000 in savings, you weren't offered a 1% loan. You were paying 18% on a credit card or 8 to 12% on a personal loan. The result was predictable. Those who already had assets multiplied them, while those who didn't fell further behind. From 2020 to 2022, the top 10% of Americans added roughly $13 trillion to their net worth. The bottom 50%, representing over 165 million people, gained about $2 trillion, 6 times less wealth for 5 times more people. This wasn't an unintended side effect. It was the design. By inflating asset prices through the banks, the Federal Reserve created a wealth effect, hoping that people who felt richer would spend more. But only asset owners got richer. Everyone else got inflation. When banks receive new money first, they get to spend it before prices rise. By the time that money trickles down to workers through wages, the cost of living has already jumped. Economists call this the Cantillon Effect, the invisible mechanism that turns monetary policy into a quiet transfer of wealth upward. The wealth effect sounds harmless, a theory that when people feel richer, they spend more, stimulating the economy. But in practice, it became the most efficient wealth transfer in modern history. When the Federal Reserve flooded the financial system with $4.5 trillion, asset prices soared, and people who owned homes, stocks, or investment portfolios suddenly saw their net worth skyrocket. A homeowner who bought a $300,000 house in 2020 was sitting on a $450,000 asset just 2 years later. Someone who had $1 million in stocks in March 2020 had more than $2 million by the end of 2021. They didn't work harder. They didn't innovate. They simply owned when the Fed decided to inflate. But the flip side of this illusion was devastating. If you were saving for that same $300,000 house, you got priced out overnight. Your wages didn't double. Your savings didn't compound. Everything you needed, housing, food, gas, healthcare, rose faster than your paycheck. The Fed called it stimulus. What it really was devaluation. Your dollars lost purchasing power so that balance sheets on Wall Street could expand. This isn't conspiracy, it's policy. The Fed's own statements confirm their goal to raise asset prices to support consumer confidence. But consumer confidence doesn't pay rent. By 2022, the median household income in the US had risen only 5 to 7%, while housing rose 30% and food prices 40%. That gap isn't a coincidence. It's the cost of stability. Inflation became the hidden tax, a tax no one voted for, no one can escape, and few even understand. You can see income tax on your paycheck. You can see sales tax on a receipt. But inflation steals silently, showing up only when your grocery bill doubles or your rent jumps by $600 a month. The irony is that the Fed insists inflation is a temporary side effect. But prices never return to normal. Once your rent climbs from $1,500 to $2,000, it doesn't go back. Inflation doesn't reverse, it compounds. It's not a temporary burn, it's a permanent scar. And that scar represents the most successful and least understood theft in economic history. For decades, owning a home was the foundation of the American dream. But after the Federal Reserve's $4.5 trillion experiment, That dream became a luxury reserved for the already wealthy. In 2019, a $300,000 home required a $60,000 down payment to avoid PMI. A young couple saving diligently, say $30,000 in the bank, was halfway there. Then came 2020. The Fed printed trillions, and housing prices exploded. By 2022, that same house cost $450,000, meaning the down payment had jumped to $90,000. The couple saved more, maybe another $20,000, but the target moved faster than they could chase it. In nominal terms, they were richer. In real terms, they were further behind. This wasn't a market miracle, it was monetary distortion. Low interest rates and printed liquidity created an artificial demand wave. Wealthy investors, corporate landlords, and private equity firms, companies like BlackRock, Blackstone, and Invitation Homes, borrowed at near zero interest to buy homes in bulk. They weren't building communities, they were building portfolios. As individuals struggled to outbid corporations with unlimited leverage, entire neighborhoods transformed into rental markets owned by Wall Street. By 2023, institutional investors owned over 500,000 single-family homes in the US, many purchased during the low-rate years. And now that rates are higher, they're cashing in through record rents, while average Americans face 7% mortgages on homes that cost 40% more than before the pandemic. The result? A locked generation, millions of millennials and Gen Z workers forced into permanent renter status, paying inflated prices for assets they'll never own. The cruel irony? The Fed claims its actions prevented a housing collapse. In truth, it created a housing cartel, a market where prices can't fall because too much printed money is trapped inside the walls. When the Fed inflated asset prices, it didn't just distort the market, it stole the future of those who were saving for it. When the Federal Reserve printed $4.5 trillion, most Americans thought that money was going to them. After all, they received stimulus checks, right? But the math tells a different story. The combined stimulus payments from 2020 to 2021, $1,200, $600, and $1,400 totaled about $3,200 per person. Multiply that by 330 million Americans, and you get roughly $1 trillion. So where was the other $3.5 trillion? It never reached your wallet. It went directly to financial institutions, corporations, and asset markets through the Fed's asset purchasing program. When the Fed buys treasury bonds and mortgage-backed securities, it gives banks new cash reserves. Banks then use that money to buy even more assets, not to lend to small businesses or households. They purchase stocks, bonds, and derivatives, inflating prices across every market. Wealthy investors leveraged the system even further, borrowing against their portfolios at near zero rates to buy more real estate and equities. It was a feedback loop where printed money created more paper wealth, but almost none of it trickled down. Meanwhile, ordinary people got breadcrumbs. A few $1,000s in checks spread over 2 years couldn't compete with the asset inflation tsunami that the Fed unleashed. The S&P 500 doubled, luxury property values soared, and corporate profits broke records, while consumer debt and rent costs climbed to historic highs. The government called it economic support. In reality, it was a bailout for asset holders disguised as a rescue for the public. If the Fed had divided that $4.5 trillion equally among all Americans, each person would have received $13,600, or $54,000 for a family of 4. That money would have gone straight into the real economy, boosting small businesses, paying debts, or building savings. Instead, it inflated the price of everything you now struggle to afford. The illusion of stimulus wasn't just misleading, it was the cover story for a historic wealth transfer. Inflation is the perfect crime because it steals from everyone, but no one sees the theft happening in real time. You don't get a bill in the mail. You don't sign a consent form. You simply wake up one day and realize your paycheck buys less than it used to. Between 2020 and 2023, the official Consumer Price Index, CPI, claimed prices rose 18%. But that number is a polite fiction. It averages cheap electronics and declining phone costs with the real essentials: housing, food, fuel, and healthcare, which soared far higher. The reality for most families was closer to 30 to 40% inflation. Consider the daily math of survival. Eggs up 70%, gasoline doubled, rents climbed 25 to 30%. Groceries that once cost $100 now cost $140 or more. But here's the key: wages didn't rise anywhere near as fast. Median household income grew by only 5 to 7% during the same period. That means your cost of living outpaced your income by 4 to 1. Every paycheck you earned bought less food, less energy, and less shelter. That's not bad luck. That's monetary policy in action. Economists call inflation regressive tax because it punishes the poor the most. The wealthy can hedge with assets that rise in value: stocks, real estate, commodities. But the average worker holds cash, and cash dies first when inflation hits. The Federal Reserve knew this. They knew that expanding the money supply by 50% in 2 years would devalue the dollar. They did it anyway. Why? Because inflation quietly reduces the real cost of government debt. It's taxation without representation, theft without fingerprints. You didn't lose 30% of your wealth by accident, it was engineered. The Federal Reserve presents itself as an independent guardian of economic stability, but its loyalties are far from neutral. Officially, the Fed's mandate is maximum employment and stable prices. In reality, its first and most consistent priority is protecting the banking system, the very institutions that own and profit from it. Most Americans don't realize that the Fed isn't a government agency in the traditional sense. It's a hybrid entity, part public, part private, composed of 12 regional reserve banks, each owned by private member banks like J.P. Morgan, Citigroup, Wells Fargo, and Bank of America. These banks are shareholders in the system itself. That means when the Fed prints money, the first to benefit are its own shareholders. The new liquidity flows into the financial sector long before it reaches the real economy. The Fed buys securities from these banks, inflates their balance sheets, and props up the asset prices they depend on. Then, when those same banks record massive profits, they use them to buy back stock, pay bonuses, or expand credit to wealthy clients, not to ordinary workers or small businesses. Inflation isn't a bug in this system, it's the business model. The revolving door between Wall Street and the Federal Reserve ensures that this alignment remains unbroken. Jerome Powell, the current Fed chair, came from private equity. His predecessors, Janet Yellen and Ben Bernanke, left their posts to consult for financial firms or serve in government roles that preserve the same structure. This ecosystem guarantees that when crises hit, the response always looks the same: print money, save the markets, and let the public absorb the inflation. Every emergency measure, every liquidity injection, and every round of quantitative easing has one ultimate effect: preserve the asset economy at any cost. The cost, of course, is your purchasing power. The Fed doesn't serve you. It serves the system that profits from your dependency on a dollar they can devalue at will. By 2023, the Federal Reserve found itself cornered by the very system it built. After printing $4.5 trillion to rescue markets, it had only two choices: keep printing and risk runaway inflation, or raise rates and crash the debt-fueled economy it created. It chose the second option, hiking interest rates from 0% to over 5% in less than 2 years, the fastest tightening cycle in modern history. But raising rates doesn't erase the money already printed. It only makes the existing debt harder to sustain. Now, the system is trapped. If the Fed lowers rates again, inflation surges back, eroding savings further. If it keeps rates high, millions of households and businesses buckle under debt costs. The housing market freezes as 7% mortgages lock buyers out. But prices don't fall because institutional investors refuse to sell at a loss. Meanwhile, Government debt, now above $34 trillion, becomes more expensive to service. Every 1% increase in rates adds hundreds of billions in interest payments, money that must be borrowed again. The cycle feeds itself. More debt, more inflation, more erosion of value. This is why the Fed can't fix inflation. It is the inflation. The central bank's very tools are the cause of the problem, not the cure. Every path forward leads to pain. Either the currency weakens dramatically or the markets collapse. In the end, it's not the billionaires who suffer. They have assets, hedges, and offshore accounts. It's the wage earners, the renters, the savers, those living paycheck to paycheck who bear the cost of a monetary system that rewards debt and punishes discipline. The trap has closed, and there's no painless exit. For millions of millennials and Gen Z workers, the American dream didn't die naturally. It was priced out of reach by policy. The Federal Reserve's money printing didn't just inflate markets, it rewrote what it means to start a life. If you graduated after 2010, you entered an economy already distorted by the post-2008 stimulus. Wages were stagnant, rents were rising, and debt was normal. Then came 2020, and the Fed's $4.5 trillion flood turned survival into a privilege. Take a simple example. A young professional earning $55,000 in 2020 could rent a small apartment for $1,200 a month and save a few $100s after expenses. 2 years later, that same apartment cost $1,800. Gas went up, groceries went up, health insurance went up, but the paycheck barely moved. The numbers don't add up because they were never meant to. The system now rewards ownership, not effort. Those who bought homes or invested before 2020 watched their equity double. Those still saving watch their purchasing power shrink every month. This divide isn't generational in culture, it's monetary in design. The people in their 20s and 30s didn't lose wealth because they were lazy or reckless. They lost it because they entered the economy after the ladder was pulled up. 40% of millennials will never own a home, not because they don't want one, but because the Fed inflated housing faster than wages could chase it. That's not progress. It's a soft form of serfdom, where citizens rent everything while the asset-owning class collects the rent. This wasn't an accident. It was the predictable outcome of a financial system that favors those born before the printing press started running and traps those who came after. The greatest irony of the Federal Reserve's $4.5 trillion money printing is that it punished the very behavior a healthy economy should reward: saving, patience, and prudence, and instead rewarded the opposite: speculation, leverage, and debt. The message from the top was clear: don't save, borrow. Because every time the system falters, the Fed steps in to protect the gamblers. When markets crash, they print. When inflation rises, they pretend it's temporary. When debt piles up, they lower rates to make it sustainable. It's not capitalism anymore, it's monetary socialism for the rich. Consider the cycle since 2008. The reckless bets of Wall Street nearly collapsed the global economy. Instead of letting those institutions fail, the Fed bailed them out with trillions in liquidity. The same thing happened in 2020. Another wave of free money, another rescue for the same institutions. But for ordinary savers, near zero interest rates meant their deposits earned nothing. The people who lived within their means, who built savings accounts and avoided debt, watched inflation destroy 30% of their purchasing power, while the leveraged elite multiplied their wealth with borrowed money. This isn't just bad economics, it's moral rot. The Fed has created a culture where failure is profitable if you fail big enough, and discipline is punished because it can't keep up with printed money. Every bailout, every round of quantitative easing reinforces the same lesson. Take risk, inflate bubbles, and when they pop, the Fed will save you. That's not free enterprise, it's a rigged game. The winners don't innovate anymore, they speculate. The losers don't lose because of bad choices, they lose because the rules are written to keep them losing. Inflation isn't random, it's the system's scoreboard, and it tells you exactly who's been winning all along. Every currency in history has been built on trust, the belief that tomorrow, a dollar will still buy roughly what it buys today. That belief is what separates money from paper. But after $4.5 trillion in artificial liquidity and 30% of purchasing power erased, that trust has been fractured. Americans now live in an economy where saving feels pointless, where rent replaces ownership, and where working harder doesn't mean getting ahead. The Federal Reserve didn't just devalue the dollar, it devalued faith in the system itself. This isn't the first time a society has faced that reckoning. Every empire, from Rome to Britain, followed the same pattern: print money, inflate assets, protect the elite, and call it stability. But stability built on manipulation never lasts. Eventually, the bill arrives. You can raise interest rates, change accounting terms, or rename the crisis, but the outcome is the same. When money loses its meaning, people stop believing. The dollar will survive, but it won't feel the same. It will no longer represent security. It will represent control. The cost of this inflation wasn't just measured in higher prices, it was measured in lost faith. The Fed's money printer didn't just erase 30% of your savings, it erased the illusion that your money was ever safe.